Understanding the bigger time frame gives us an overview of entries that present itself for counter-trending opportunities. So in this case, we're going to be using US 100 as a point of reference to show a counter-trending opportunity. In the case where the market on the intraday level is trending to the downside, we're able to get into a counter-trending buy setup. Now, if you've been following through with my videos, this key level right here, I talked about this key level. We have a high, we have a low. This was the last down close candles before breaking structure right here. So even if we're going to continue to the downside, this area will be a significant area that price could potentially see resistance or potential support. Now, this doesn't mean that I'm saying that this will be a key level that could potentially facilitate for a bottom in the marketplace. The market could still decide to come lower after mitigating this last up push. The market could decide to still come lower. But in this video, the major reason for this video is to show a counter-trending opportunity. So whether the market is going to go lower or not, this video is to show you how to get into trades, even though the intraday levels were bearish and the 4-hour were consistently creating lower highs and lower lows. You can see that this right here is our swing 4-hour high. We mark that out, and right here is our swing 4-hour low. So we're within the range high, range low, and price came down, mitigated our key level resting right here. All we want to see from this key level is a 30-minute shift to market structure to the upside, and then we'll look for a potential buy setup. And if we're looking for a buy setup, the first thing we do, we use the Fibonacci to derive our equilibrium zone. And once price is at equilibrium, that trade buy setup will be closed. Now, what we'll look for at the equilibrium, above equilibrium, is low resistance liquidities that we're going to use as targets. So whatever trade we get into, we'll be anticipating for price to rally above the low resistance liquidity resting directly before or above the equilibrium zone. The equilibrium zone is right here, the midpoint of the Fibonacci, the 50%. Now, in order for us to derive our entry for the trade, this right here is our key level after the mitigation. We want to see a 30 minutes break of structure to the upside. And right here, as you can see, we created a high, we created a low, broke structure significantly, left an inefficiency. Now we're anticipating to see price come back to retest this inefficiency. And once price retests this inefficiency, we'll be looking to see a 4 minutes break of structure to the upside. Now we'll go to the 4 minutes time frame. As you can see, after price mitigated that key level, created a high, created a low, broke structure significantly right here. This was the last down close candle before breaking structure. That's going to be our entry position. Our stop loss is going to be this low entry right here. You can see how price broke structure, came back, mitigated the last down close candles. We'll go to 15 minutes time frame. After we mitigated it, price rallied, came back again, mitigated it second time, and expanded to the upside, rallying above low resistance liquidity, resting directly above the equilibrium zone. So you can pretty much see how we scale down from daily to derive our point of interest. We went to 30 minutes time frame to see our break of structure right here, and after that we waited for a retest inefficiency, and after the retest we waited again for 4 minutes break of structure and 4 minutes broke structure, and then we use this key level as our entry position. Take profit position. We have two confluences to align. Firstly, equilibrium zone. Secondly, low resistance liquidity resting right here. Why is this a low resistance liquidity? Because there was no liquidity, external liquidity, that was taken before price dropped. So which means any move coming towards this upside, there's a higher chance it's going to rally above this key level. Now, as you can see, the trade delivered a 1:4.3. What I'm watching now is to see the reaction in price from this key level. Two things are going to happen in this key level. It's either price will mitigate this key level and use it as resistance to potentially run sell side liquidity, or we're going to rally above it. If we rally above this key level and close above it, I'll see that as a potential shift in market structure, and I wouldn't really be interested in the market going lower to run the sell side anymore. If we break above this high, I'll only be interested in the potential continuation. But if we mitigate it and I see a solid displacement, there will be a high chance price will hunt for the sell side liquidities. But for now, I'm on the sidelines. I'm watching this key level. If we reject off this key level and drop off, then this will be my next run of liquidity, sell side liquidity, and I'll be anticipating for the market to come down in here. Why? Because overall, if we go to the monthly time frame, we'll have a high, a low, and a break of structure. And this right here is the last down close candles. Exactly how I showed this to you on the 15 minutes time frame. High, low, break of structure, last down close candle. I want to see price come to a last down close candle. It's pretty much the same for every single time frame for me. When I'm trading, you can see high, low, break, last down close candles, and price came in there, reaccumulation, expansion. So you can see how I'm showing you something on the 5 minutes, same structure, and I'm seeing same structure on the monthly time frame. So it doesn't mean for certainty this is going to happen, the price is going to come here. But the reason I usually mark this out is when it does come, or if it does come, I'll be ready and I'll know what to do. The worst thing that can happen to a trader is not being ready for things to happen. It may not happen exactly how you want it to happen. You are not always going to be right. There's going to be times when you do analysis and price doesn't even do any single thing you want it to do. That's absolutely okay. It's part of trading. No trader is perfect. No trader has 100% win rates. All we do is to participate in the marketplace, look for high probability opportunities. There's no guarantee the high probability opportunity is going to work. But the only thing that is going to work in our favor is risk management. As long as we use good risk management parameters, we will always end up profitable at the end of the day. So I'm going to end this one right here. If you enjoyed this one, feel free to give it a thumbs up. You can follow us or subscribe to our channel for more videos like this.